How do you underwrite mixed use? Do you go by NOI and divide it by cap rate?
We do the income model, looking at the profit, the NOI that an asset will generate. And that's always the most important way to do it. The smaller the asset, the more that comps kind of come into play. Whereas the bigger you get, it really becomes about the numbers and structure and location.
Hello, everyone, and welcome back to another episode of Path of Progress. First of all, Happy New Year, everyone. This is our first episode in 2026, and I'm excited to bring this guest tonight. This guest truly believes you can do well by doing good and has built his entire real estate business around this principle. Dave Holman is a commercial broker, investor, syndicator, and the owner of Katahdin Property Management. He owns and manages over 300 units and has 200 more in the construction pipeline, and focuses on driving NOI through energy efficiency, creative financing, and community-first operations. Dave, welcome to the show.
Thanks for having me, Alex. Excited to chat.
I'm excited to have you on here. I know we've talked a few months ago, but now we finally found some time, and it's first episode of 2026. Pretty exciting.
Yeah. Glad to be first. I'll set a low bar for everyone afterwards, so it's not intimidating.
Anyhow, Dave, let's start from very beginning. Let's start with your origin story. Where did you come from, and how did you come out about this real estate world?
I was born in Maine Medical Center in Portland, Maine, back in 1983. So that places me on the older end of the millennial spectrum. And I had no relationship with real estate investing, commercial real estate whatsoever growing up, kind of average middle class background here in Maine, which is a pretty rural state. I went to college and started learning about green building, LEED standards, energy efficiency, climate change, things of that nature that really got me interested more in business and economics as some of the levers and gears behind the trends that we see in the built environment. Like most other people, I went down to Bolivia for the next 4 years, started a chain of retail stores with a young woman that I had met and was dating from Bolivia. We're now married with 2 kids, 2 goats, a duck, a turkey, 2 chickens, and a dog. So we're
Very typical
growing.
Maine, ducks, chicks. Wow.
Yeah, a little lumber
Very
business.
stereotypical. Good.
Yeah, no, I made sure to wear my plaid, to our interview today to be on brand for Maine represented. But no, I love where I live, and that's a big part of my real estate story. Is that the vast majority of it centers within an hour of where I live, and that's the market that I invest in. That's where I consider myself an expert. That's really all that I try to focus on, is my own community and the communities right around me, which is very different than many other investors who are often remote, targeting the Sun Belt, the Midwest, Texas, different markets that have been hot or are hot. I started out just thinking I would buy like one cheap condo a year and pay them off over 10 or 15 years. And that would be my kids' college savings or education. And turns out buying a condo every year is not a very good real estate investing strategy, HOAs, and not a great economies of scale and everything else. So started with a single family home as an investment, partnered with family who had the capital for retirement to deploy for something profitable, and said, hey, we'll split it. I'll do all the work, get some of the equity, you put in the capital and get better returns than you might get in the stock market. And that has worked out really well. And I kind of quickly outgrew that family arrangement after 2 or 3 deals and started going to friends and saying, hey, I think I can make you good returns doing something that improves dilapidated buildings in our community, that makes them more energy efficient. And that snowball started rolling. And I had gotten my MBA, so I worked in fundraising. So those were both, really important skills to transfer to real estate investing. And pretty quickly realized the property managers I was using weren't working out. I had to start my own company. That's now grown to 17 employees, leasing department, maintenance department. So we're taking care of a lot of our own issues now, which is really nice. And it helps kind of diversify the operation.
We have a lot to cover. If you just jump from zero to hey, we are vertically integrated, 17 people in the company, we are a big company now, and we're big shot. So let's start with your first deal. Let's tune back to that. Tell me about this. How did you find the deal, and do you still own that property?
I do. Yeah, we actually just were deciding whether we sell it, refinance, or just re-rent. It's a single family home in a town next to mine, which is a very affluent town. We bought this in the late teens, I think 2016, and I did it with a residential agent because it was a single family house, and I thought I had stumbled on a great deal because the town was going to change its zoning, and this large single lot I thought was about to become a double lot. And here's my first lesson I'll impart to your listeners is just because you think you're in the path of progress, until the law is written, it ain't so. And lo and behold, the NIMBYs got out their pitchforks and torches, changed all the zoning to make it more NIMBY-ish. And lo and behold, I couldn't split that lot and get all this extra, 50 or 100 grand of value out of what I basically paid market price for an average Cape 1,200 square foot house in that day and age. So that would have been a pretty mundane ho-hum kind of investment. Not bad. You're not going to lose money paying market for a house, but you have to hold it for 10 or 20 years to really feel like you did well. Luckily, with COVID, the price of that house has doubled. We refinanced in like 2018 or 19, got a 3% loan. Here's a little cheat. Our bank was willing to give a 30-year residential fixed rate mortgage to our LLC that owned the property, which is usually not something banks are willing to entertain. So like, if you don't ask, you won't learn something, but don't just assume, because usually banks don't do residential loans to commercial entities that they all won't. Some will. The big ones won't. Wells Fargo, Bank of America, and I would strongly recommend people have nothing to do with them. Get them out of your lives as quickly as possible if you've got a relationship there, unless you're like a 50 or $100 million plus kind of deal. So
I
we
think the
had
big lesson here is that you need to talk to your local lenders, right? This is what your local bank.
yeah,
Small banks that they have appetite for such property, and they have no problem because they know this areas, they know this neighborhoods, and they're more comfortable with this kind of assets.
they'll often be a lot easier to deal with, especially if things go wrong, if things aren't as planned. You want someone who's going to your local Little League games, who's going to see you and care about you and know you and trust you. That'll be a lot easier to jump over a hurdle because you're just a number to Bank of America, and if they need liquidity, they're going to kill you. So, they have
Switch.
no problem foreclosing on you. You're nothing to them. Whereas your local banks, I think building those relationships over time is great. And another key lesson I learned is I used the same bank for my first like 7 deals, and I never shopped it around. I never
Uh,
checked the interest rates. And in retrospect, that was a mistake. And I now shop deals to 3 to 10 banks, just depending on what it is and which ones we think might be a good fit. And a lot of times you can work with the bank you like, but they'll give you the terms of the bank that was most competitive. Uh,
and it's easier to shop the rates when you have experience. So in retrospect, it actually was good for you because you got that valuable experience with the bank and you build a relationship. You probably get a good rate, regardless if you would shop around. But now that since you have experience, other players ready to step up and want your business now, right?
Yeah, that's exactly right, Alex. And I really encourage people to start small and work your way up. There are other gurus like Grant Cardone who would tell you, no, nothing less than 40 units for your first deal. It's worth it. And different strokes for different folks. That might work great for a very risk tolerant individual with no family and nothing to lose. But for me, I did have a family. That's why I started real estate investing, is because we had a kid on the way and I wanted a way to do better than my salary at the nonprofit I was working at the time. So I think that starting small is great. Learn to crawl before you walk, before you run. And it's taken me, almost 10 years of consistent action over time to get where I am.
I love it. So first property, was it an investment property or your first home residence?
Oh, yeah, we bought a single family home to live in 2013. So that was the first investment. And we did a lot of DIYing. I did all my own wood flooring throughout. It took me like 6 months going room to room. And I think that building that sweat equity, building some of those basic skills helps you navigate contractors and things like that in the future. You just want to know enough to be dangerous. You don't have to be a cabinet maker, an electrician, or a plumber. But if you learn some of the vocabulary and can kind of sense whether this is a $200 or $2,000 issue, that'll help you avoid getting kind of taken advantage of by contractors who sometimes, if they see a sucker, you're going to get a bill that's 3 or 4 times what it maybe would have been if you had asked the right questions.
It works in other direction too. If you had a Zurich lock and you had to rent a machine from Home Depot and do it yourself, the next time like $300 is not that bad.
Yep. No, I'm very much at the stage where I think my time's really valuable and I'll happily pay professionals a fair price to do work that I would otherwise be DIYing. And I'm now at the point where like slap myself on the wrist. I'm only DIYing stuff if it's for like my own mental health and like I just want to stack that wood or do this thing, which I like to do, but I'm not pretending that I'm doing it to save money.
100% love it. So you got your first investment property, you got your primary residence. What was your next step?
We did another single family house, just kind of the same thing. And then I stumbled on a mixed use deal, and I was still with a residential broker at the time. I wasn't able to find any good deals, or so I thought, of single families in that day. I mean, I kind of kicked myself because I was like 150 grand for a house. Like, no way, that's too much. And now they're worth 400. But, oh well. Anything that you've bought in the teens and held to now, you should be up on a lot, or something went horribly wrong. So the next one was two residential apartments up over a commercial tenant. And, my agent kind of guided me. He was like, this is called mixed use. And the bottom could eventually, you could make it a triple net lease. And I was like, what the heck is that? What's triple? What's net? Like, what does that all mean? And he said, no, it's just like a residential apartment tenant, except they'll also pay their share of your taxes on the property and insurance in addition to all their utilities. And I was like, no, like they would do that? He's like, yeah. And I was like, whoa. And it turned out to be a great deal and negotiated it. But they were a tenant that owned the building as well. And they didn't want the real estate anymore because the original partners were retiring. And that's a scenario I found multiple other times. And I love those deals. Those can be really good deals where you're getting an owner like tenant who wants to stay on, that's taken great care of a building because they owned it. And now they just want to be a renter. And they're often willing to pay a very good rent price because they're selling the building and getting 6 or 7 figures out of that. So those can be really good opportunities. And that's what happened is I had that firm in there for a few years. And when they grew and left, I broke it up into 5 little individual offices, which gave me an overall better cash flow. And that's how that same building is now from 2017.
So you mentioned mixed use. Mixed use is meaning you have commercial and residential. How many residential units you have there?
That one's just 2. Yep, 2 residential and now 5 commercial technically, because a room that you rent as an office for $500 a month, I mean, that is a unit in commercial worlds. And I love mixed use as an asset class precisely because nobody else does. And I don't want competition. And I think that a lot of people reject it because it's complicated or it mixes different asset classes, one of which they may love and be familiar with, and one of which they're not. Great. You pass on that deal, I'll check it out. And there's very few other investors and people that are looking for mixed use and can unlock some of the value there. But a lot of times they will be undervaluing the residential portion of that real estate and focusing on the commercial users of it. And that can be a great way to find residential apartments at 70% off or 50% off or something like that. At times, there's other times when they're going to charge market rate and you're not saving any money from the complexity. So I'm not saying it's always a good deal, but anytime that you can fish in a pond that other people are kind of scorning or rejecting based on not so legitimate reasons, you can find a lot better deals more easily.
Okay, fair enough. Now, how do you underwrite mixed use? Do you go by NOI and divide it by cap rate to understand the value because it has mixed use, so it's commercial, it's a business, right?
Yeah, it somewhat depends on the size. If it's under, say, 500,000, it's often going to be fewer than 4 units. If you wanted to, you could use residential financing on 4 or fewer units. Generally, the banks won't do commercial mixed in with that. But again, once in a while, I've seen them be willing to do that. So again, it can't hurt to ask. 9 times out of 10, you're not going to get a yes answer to that. But we do the income model, looking at the profit, the NOI that an asset will generate. I mean, that's always the most important way to do it, I think. The smaller the asset, the more that comps kind of come into play. And if you're looking at a simple 4-unit apartment building, I mean, there's going to be comps for that. And even if yours has great rents or terrible rents, it's more about the structure of the building and the location than it is about those numbers. Whereas the bigger you get, it really becomes about the numbers, and structure and location are important, but less so than the smaller deals.
So how do you finance those deals?
I work with commercial lenders almost entirely. I hate residential lending. They're so I joke with people because I bought a condo a few years ago, and it was harder to get that $250,000 condo loan than it was to get a $13.5 million construction loan to build a 63 unit building. Way harder. So be advised that there are nice things about going to the commercial side of the lending world. Those loan officers are much more, I think, creative and flexible.
More professional.
Yeah, and professional. And they will, they're underwriting the asset first and foremost, and you secondarily. So it is not as critical that you have your own W-2 income to support the asset you're buying in the commercial side. So we're using commercial lending. A lot of times I'm trying to get seller financing mixed in, because if you can get 10% seller financing, then your lender will let you go down to a 10% down payment. And that can really goose a cash on cash return in a good investment. It can also get you over leveraged and in trouble if you're not underwriting your deal well. So just be advised that going to 90% LTV at the outset is for when you know that A, you either have reserves that you can add if you need to, or B, you're extremely confident about the fact that you're getting a good deal.
Very good. Okay, it's very exciting. So you got mixed use, and now you plan with commercial. And how did you grow to your numbers today? What was your strategy to grow? Did you focus on apartments, or you stayed focused on mixed use buildings, but on a bigger scale?
Yeah, it's a great question. I think the most important criteria for me is locations. So if I can be on a cute, walkable downtown main street, I'll happily get an asset that I might otherwise never be interested if it's a block or two away or a town or two away. So that to me is really fundamental, because those are things that are not going to change. Like AI isn't going to make your cute main street less cute. People are still going to want to go out to eat at restaurants in the future. So I think there's a great value play for location, and that's like the location in real estate. It really is true. But I try to stick with asset classes I know and like. I mean, multifamily residential to me is the gold standard. I like that. There's, Maine, we have a huge housing deficit, housing crisis. Rents have increased dramatically. There's a less than 3% vacancy rate statewide. I mean, we really are in a crunch for housing. And in a lot of markets, like I'll give like Austin, Texas, an example. Like they were in a crunch for housing when all the tech folks started moving there about 10 years ago, and developers came to the rescue. They built thousands and thousands and thousands of units. And lo and behold, they oversupplied the market. Rents have gone down 10% in the last year. And it's, people are having some cash calls. There's some you can get some months of free rent if you move to Austin or one of these markets that was really hot that everyone was piling into in prior years. So I think that's why I look at the tertiary markets, the kind of unsexy assets and places that you're not going to be competing with money flowing from out of state just based on very public trends. I think it's much more important to know a market really well, whether it's hot, cold, or medium, and find good deals within that.
But I think to your point to Austin, I read a report of U-Haul. That's again number 3 cities where people migrate is Austin, Houston, and Dallas.
It's everyone, I think, rightly looks at population growth, and that's really key. Obviously, population growth. You want a growing population, but if your housing supply grows faster than your population, that is not good for you as a landlord. and I think like that has happened in markets that made it easy to build. And like like that's how it should be. Like I think that's how America should build housing, by making it easy for developers to meet demand and say, yep, there's demand to be in this awesome downtown dense residential area where there's already utilities, already services. They want highly amenitized big buildings to live in and work from. Let's build those and let the developers like us take the risk. If we oversupply it, we're going to be out. But in a lot of markets, San Francisco, New York, Boston, I mean, that are just highly regulated, they're anti-housing. They're saying no to supply. They're making it impossible. It costs $600,000 a unit to build in San Francisco. And that's not because lumber can't be shipped there, or labor can't be found there. If you removed a lot of the artificial regulatory barriers, you could build housing for a very similar cost in those municipalities as others. So I think it is true to you want growing population. That's all well and good, but you could make money if the housing supply was falling faster than the population, even if the population's falling. So I would look at that delta, that net of what is the need for housing, and is that supply increasing faster than the demand or not?
Yeah, that makes sense. Now, Dave, can you share with us your best acquisition to date, your favorite deal?
Yeah, it was a vacant office building, which is exactly the kind of asset that nobody ought to touch in their right mind, right? Like, oh my God, office, it's so bad now. Everyone's working remotely and vacant, there's no cash flow. Like, oh my God. Well, that's true. And therefore you can get that kind of building half off, a third off. And all you have to do is fill it with a tenant. And all of a sudden you've got an income model that justifies a totally different price. You need a risk appetite. You need a little bit of dry powder to sustain 6 months of vacancy or whatever it might be. But a lot of times you could get something under contract, find a tenant for it before you close, and your value at closing is double what you went under contract for. So that's the high risk, high reward that worked out for me in this one office building very well. We bought it for 1.1 million. A year later, it appraised for 2.7. And we're doing a construction project on it now that'll pay as much just for some land off of it. That's been, we've already paid investors over 150% back, and we're about to get that amount again, and we'll still own the asset. So that's not my typical deal. I don't want to be able to think that it's just all home runs with Dave. A lot of syndicators would have you think that, but the key is getting on base and not striking out. The key is not losing money, as Warren Buffett would say. And that to me is very important.
So how are you certain that you can fill the building? If the previous operator failed at the same task, they couldn't fill it, that's why they're selling. They wouldn't sell if they would be normal. Is there any story behind it that you're looking for in those deals? Or
there's always a story. There's always a story. And in this one, it was a law firm that, again, the retiring partners were going their separate ways. They didn't want to own the real estate. The remaining firm was planning to move out of the building. So it was being marketed as like a vacant owner occupant kind of space. I was brought in by a colleague who had it listed, because I'm also a commercial broker, to just get my opinion on it and help this colleague kind of market it and figure out how to present it. And after the tour, I was like, wait a minute, these lawyers, like, would they stay and rent part of the building back, like the little part they're using? She's like, oh yeah, they'd love to. I was like, and aren't they doing that now with the old partners, the sellers? She's like, oh yeah, they're paying 12 grand a month. I'm like, I did some numbers. I was like, well, why don't I just buy it? 12 grand a month. I mean, that was way more than my mortgage. All right. That was like all costs, all in. I was already going to be breaking even with the building more than half vacant from the get-go. And it's just because no one had asked. And that wasn't how it was being presented by the broker. So again, I love properties that are not like well marketed. If you see grainy photos and like a lazy listing by a broker, or just something that like, well, yeah, I know they're pitching it as owner occupant, but there's someone still there. Like, would they want to stay? Would they pay rent to stay? Like that? Those are all questions that are not expensive to ask. They're free to ask, and you can find really good deals that way.
wow, love it. And what about the rest of the building? How was you certain that you can fill the rest of the building? Oh, it doesn't matter because you already break even, you already have money.
Yeah, certain would be the wrong word, but confident might be a better word. And it's funny because we closed in March of 2020, and the seller flew in from San Francisco, where the first COVID cases were just getting diagnosed, and the sky absolutely fell as soon as we closed on that building.
Oh,
And I was very
wow.
worried. I will tell you, Alex, that was not a good feeling. And we spent like 4 months trying to rent like 10,000 square feet of vacant commercial space in the worst time to rent commercial in 100 years. Since the Great Depression, there's not been a worse time to try to fill a commercial space than spring of 2020. And so I went back to the strategy that I used on that first mixed use building. And I said, it's hard to fill big, empty single spaces. I'm going to chunk this up into single offices. And rather than trying to get 5 grand a month from one tenant, let's try to get 500 a month from 20 tenants. And lo and behold, we started filling them. And one by one, we started finding offices or office suites. This tenant's paying 1,200, that one's 2,000, that one's 500. And we filled it with 17 different renters. It's diversified. And that diversity is really great. I think when you have a single tenant triple net asset, you're either happy, all occupied, or you're 100% vacant and you're in a crisis. And I don't really like that. I prefer to have diversity, where if one or two leave, oh, we go from high profit to low profit. Some more leave, we're going from low profit to breaking even. But there's not usually a crisis scenario if you have a good rentable asset. You just drop your rents a little bit, fill it back up, and you can increase them over time.
Single family versus multifamily, right? Multiple units versus one unit. Now, tell me this: how did you get this strategy, and where do you get money? Do you have to renovate this place? Do you have to reposition it somehow, or you just came in, you just split it? How did you do it? How do you know how to do it? Did you have a mentor? Did you have someone in your circle who knew how to execute on this strategy?
Yeah, that's a great question. I didn't have a single mentor per se. I tried to invite people that were in this realm to coffee a lot in my early years, and I still try to connect with people that are doing better things than me. Because I think you're never going to be the best. You might think you are, but you're not. So you should always try to network and learn from people that are better than you, and try to ask a lot of questions. And sometimes the smartest person in the room is the blue collar plumber that didn't graduate high school, that has a great way to solve your problem that some PhD engineer would charge you 50 grand to do worse than they would. So don't assume too much at the outset of things. And in terms of funding, with deals now, I'm bringing in, friend, family investors, and now it's friends of friends. I mean, people that come in from podcasts or whatever it may be that I build a relationship with. They like and trust what I'm doing and want to try it out. And I put in my own money. I think that's a kind of key part as a syndicator, that you've got real skin of yours in the game. You're not just getting part of the GP for free and letting everyone else pay the actual cash bills. You need to have skin in the game in a big way. You don't always have to be the biggest, but I think that component I really value. And then we're going to banks often with an acquisition and construction loan component for buildings. I do a lot of historic projects that need work. We're adding 8 units to a historic building in a downtown right now. And so we've got like an $800,000 construction loan as part of that. And the nice thing about doing that kind of financing is that the bank will often be willing to do interest only for years. And the bigger the construction, the longer they'll be willing to go. And that halves your bank payment every month. And that gooses your cash flow quite significantly in your overall pro forma returns. So it's almost better if you can do some kind of construction and fixing up than if you're just buying a stabilized asset. The bank will say, like, it's stabilized. Like, you don't need interest only, IO in the lingo of our folks. And then you're paying principal payments from day one.
So it's basically a bridge loan that you get in from those banks, right? Or do you have some custom loans that you get in for that?
Yeah, it's a good question. I've never actually used bridge financing. It's all been commercial loans with a 5 or 10 or 7 year fix. And so the construction loan component you do in draws as you do the construction. So you would raise enough money to get started. For every 100 or 200 grand you spend, you go to the bank and say, hey, here's all the receipts, the lien waivers from the builders, give us our next draw. They, put another 200 grand into your account. You keep going and paying until you're done with the project, basically.
What was your rate on the last deal that you did?
6.22%.
And it's including the renovation, the rehab, the construction part. Wow.
Yep.
And how
Yep.
many years of interest only did you get?
2.
Wow. Incredible.
It was a good deal. And that bank was pretty hungry to work with me. I've actually got a quote right now for 5.89 from another one, which is the first 5 I've heard of or seen in the wild in a long time. So that's really exciting. That's with a kind of loan called a swap, which is, you wouldn't do it on a property of less than $1 million in value. Half of the banks are like scared by them and don't do them because it involves more risk for the bank. The nice thing is, in my opinion, as long as you're not planning to get out of your loan early, it doesn't involve more risk for you as a borrower. It just lowers the rate by 20 to even 50 basis points, which the bigger the deal, the more that is a really consequential difference. So as you grow and get more sophisticated, investigating swaps can be interesting. And if the rates change to your benefit, you can get paid to break your loan early because the bank's losing money on it. I won't get into all the complexity because honestly, I don't understand it all myself, but they are a good legitimate form of loan for bigger deals.
Very interesting. Okay, so I like acquisition side, I like investor, like mindset approach, but let's talk about your operational side. When did you decide to grow vertically, be vertically integrated? When your property management company got born?
Yeah, that's a great question. I strive to be an A student. Sometimes I only get Bs. But my property managers were getting like C's and D's and F's, in my opinion. And it was really annoying. Vacancies would just linger for weeks and weeks. I'd be like, well, didn't you think to maybe lower the rent or try X, Y, or Z? And, they were just not on the ball the way I wanted my properties to have good management. And I had a friend from grad school who was looking for work. And I said, hey, let's make a company and grow it together and manage these properties, and we'll take on more. And that's grown and grown over time. And we do mostly in-house properties that we sort of own and control, but we also do some third-party management for owners that we like, basically. We're a little bit picky. I think that's important because otherwise you'll have a lot of headaches for little things that aren't worth it. But we try to work with people who are insanely overqualified and not looking for corporate full-time work. They want to work with a company that they believe in, that does good things, and they're willing to work for much less than they could go out and get at a bank, insurance company, or other place. And so we've kind of built our company around a lot of people with no property management experience or background, because you can learn any skill, right? I mean, anyone who has eyes, ears, and a brain can learn new skills. You can't learn like character and honesty and like things like that I would rather pay extra for, to work with good people who I trust and who are going to be trying to do the right thing for me, because we get along well and it's a fun work atmosphere. I've been in job environments where there was a lot of stress and people not being great to each other and drama. And I don't want that. Like, let's build a team that's happy and works together well. And I'll pay a premium for that because I think they'll be twice as productive as the people that you're trying to pay minimum wage to and nickel and diming and so forth. And that's really what I found. I mean, I swear that I have team members on our team that get more done in 1 hour than a lot of other random people would in 3 or 4 or 5. And I'm fine paying them 30% more than what they would make at a regular property management company.
Tell me this, are you treating this company as a separate entity that has its own income, or it's connected to your company and you just shaving some of the costs of running operational part?
It's a totally separate entity. I'm using the Amazon tech startup model where it's just breaking even. So I have never distributed profits to myself from the company. Now, I very much hope someday to do that as it grows and gets economies of scale. But right now, I really see property management as risk management. For the assets, like the value is in the property. That's where we are trying to profit, is by driving NOI, lowering expenses, raising income. And that's what it's all about. And that's where property management is really critical, because they can lower expenses with good ideas and hard work. They can raise income with good ideas and hard work. And that's every dollar of NOI that you can create is worth 10 times, 20 times more than a dollar of profit that you can extract as a manager, in my opinion.
No, 100%. But tell me this. I know some people like to grow vertically integrated so they can save costs on renewals, right? Because it's like when you fill a new place, you have to pay half a month or full months of listen fee. When you have late fees, etc., etc., it's all piling up, and the property has these expenses to pay. When you run your own property management company, have your property, do you still have the same costs applying to property manager if they have renewal? You have to pay listen fee. If you have late fee, you have other fees, etc., and you have management, construction, you have some repairs going on. Do you have a charge for this? Why I'm asking is, when you create your company as a property manager and you get new clients, you should have the same exact model treating yourself or other people. How do you go about it?
Yep. Yeah, we do. We treat other clients largely the same as we do ourselves internally. Not even because we wouldn't charge others more, as much as it's just too much to keep track of. If this building's that way and this building's that way, and we're doing everything custom and different. So yeah, we just charge, a percentage fee of gross monthly rents. We're generally, with few exceptions, not charging lease up fees or other smaller fees. Our maintenance division, we have a markup on that. So we're billing them at a higher rate than what we're paying them. But the nice thing is it's a win-win, because that rate is still less than we would get from other handymen, contractors, companies coming in to service us as third parties. So I do think that that's where I'd prefer to have some arbitrage and profit than like a collection of little fees, which is hidden and irksome to the customer.
I think you have to, because you have to pay salaries to the people, right? You have to have the certain models that work. And at some point, I hope you'll get dividends from that company as well as it grows to be a independent property management, fully independent property management company without your involvement. Now, tell me this, what are your goals for the future with your property management company, with your real estate transactions? Where are you trying to focus and where are you trying to grow to?
Yeah, I'm trying to find ways to have profitable buildings that don't use any fossil fuels and that are energy efficient, both because I think it's the right thing to do from a science perspective, but also because that lowers your operating costs significantly. It drives NOI. And every dollar you put into insulating an old building that you were paying the heating bill is going to give you 10 or $20 when you go to sell it, in years to come. Those are good, high ROI investments when you can do passive things to improve things. A lot of people think it's all about solar panels or high tech equipment, and we often have problems. The higher tech you get, the more headaches that can generate. So my goals are not only to do that in my own buildings, but to educate other owners, other people, so that this can spread. Because I think there are a lot of win-wins out there that people might ignore or not know about because it's not business as usual. Converting buildings to heat pumps is a huge strategy of ours, where in the Northeast, a lot of buildings are in a central heating system. It's often oil, not even natural gas. And the landlord is paying 10 or 20 grand a year heating
Yep.
bill. And for 30 or 40 grand in total, you can put a single heat pump in each unit. You can probably insulate the attic a bit better. It's a big capital upfront cost, $5,000 or $6,000 per unit, let's say. But when you're done, your annual 10 or 20 grand of heating goes to zero. And you don't really have to lower rents when you do that. A tenant will be paying a higher electric bill. There's some that might need help or phasing to get into that, and we do that often enough. But other times, that extra $100 a month is not a deal breaker for folks that are happy where they are. And I think that is a huge win-win for the tenant, for the environment. I mean, they get AC, they get air filtering, they get a more reliable heat source, and you get redundancy. If my big boiler goes down in a centrally heated building, I'm screwed. Like, everyone needs a hotel in the dead of winter. Like, it is dire. Whereas, 1 out of my 10 units doesn't have heat. I'll just go get a heat fan. The technician will be there in a few days and fix it, or whatever. But it's 1 out of 10 versus 10 out of 10. So that redundancy is also risk control, risk management.
And it's sort of humanity, right? Because people like to control things, because they like to own stuff. And when you put them in apartments, they can control the temperature. Everyone has their own temperature, preferences. Some like cooler, some like heater. If you heat one building certain temperature and everyone's complaining, it's not good. But one person is like, he's cold all the time. But now everyone has their own temperatures and gauges. I have the same thing. I have the whole building, 6 unit was heated by one heating system, and we just break it up out to electrical, and everyone's all of a sudden happy, and they pay their own bills for electrical, and I don't pay any more gas bills. And I'm like, wow, that was fun. In 1 year, I think it all made worth it for my change
Yeah.
for the bill.
Yeah, it can be a six-figure increase in value when you spend five figures on these kind of upgrades. And so the juice is worth the squeeze in that one. There's other examples. If you're doing like triple paned argon glass windows in a low income rental, like, that juice is probably not going to be worth the squeeze. Heat prizes, the best window versus the worst window, is not that huge of a cost as long as they're air sealed. Air sealing is very high ROI activity. A little bit of caulk and spray foam can save you thousands of dollars of heat over years. And you do it once and it's done forever.
Usually simple things are the most reliable and neglected, right? Because people don't think it's actually going to change anything. But that's what happens. Now, tell me this. I like your strategy. I like your focus on environmental part. But tell me about your acquisition. What goals do you have on the next 5 years to grow your portfolio? Do you have a door number in mind, or do you have some income in mind that you're trying to achieve?
Yeah, I have two projects in the due diligence and permitting phase now, and I want to get both of those shovels in the ground by the end of 2026. And those are big. One's 183 units of
Wow.
apartments, and the other is probably going to be 38 units of condos. So those are the two top priorities, but I have pretty big visions. Maine recent study came out that we have an 80,000 housing unit shortage, and we're producing about 2,000 to 3,000 a year. 2,500 in a good year. So in about 40 years, 30, 40 years, we might be great. But for now, there's a huge need for housing. And I think I really like to see density, not sprawl. I think sprawl is not good for the environment. It's not really good for people, commutes. A lot of these cities that have sprawled out, I'm not looking at you, Atlanta, LA, etc. These commute times, people hate it. And it takes years off your life and stress to be in traffic like that. I think we should build on density. You should be able to walk to most of what you need in your life if you want to. I mean, I'm a country bumpkin. I live in a rural road and I'm fine with that. But I think most people love to be in a community. And so we're trying to build communities in these buildings, and have social clubs that meet in our buildings and networking opportunities, dinner parties, Super Bowl parties for the residents, so that they can bond with this place. And, it's the right thing to do. I think that you do that kind of thing, but it also, I mean, you're looking at turnover and for people that like where they live, they'll stay a lot longer than if it's just, oh, I pay rent for a box that I live in and there's no community aspect whatsoever other than what I might do on my own.
Okay, Dave, but you have to tell me, how did you go from single family to
Yeah.
off mixed use office building? Now you ground up, focused on 183 unit plus multifamily. I mean, that's a big jump. Each single jump is pretty big, but
Three
two of
things.
them.
Yeah, three things. OPM, other people's money, working with investors. I didn't have my own capital. I wasn't rich to start with. And if you don't have that network, you might have to build it. Two is like brutal honesty. If things aren't going well, I'm not going to hide that. I'm not going to sugarcoat that. I mean, there's a limit to, like, you don't need to tell the investors about the vomit you cleaned up last week or whatever, but you got to be honest as an operator. And I would rather do that and maintain my reputation than pull the wool over people's eyes and have something blow up. And then three is finding good deals. I mean, you have to legitimately find good investment opportunities. They don't have to be out of the park. I'm on a lot of mailing lists and I get these like, oh, 25, 30% IRR deal and retirement, whatever. And I'm like, it's going to be
15
hard.
cap rate.
Yeah, no. I mean, I'm feeling pretty good with a 15% IRR. Like that, those mid-teens, I think are achievable, and so far so good. So those are the three big things: is just being
For the
honest.
ground up. But how did you get into ground up?
Oh, a friend of mine from college that I partnered with on this first big construction project had been doing it for the past 10 years. So he was the expert. He knew how this goes. I never would have attempted a 63 unit apartment building as my first ground up project otherwise. And I think that's what a lot of real estate success is about, is finding good partners that you know, like, and trust, being very wary. If it's just for money, don't do it. It has to be someone that's going to have your back when times are tough and that you can work out hard problems, because it's like a marriage. Like, you're going to have tough, weird differences that you've got to resolve with these partners. And if you're just there to profit for convenience, I mean, someone's back is going to get stabbed somewhere. And I'd rather limit my partners, but have them be people we can work out tough problems with.
100%. So what I hear is network collaboration, right? Regardless if you need money or if you need knowledge or if you need some skills or time, someone can contribute something. But if you network, you're open-minded what you do and how you do it, and you're honest about your operations day to day, people will come back to you with money to invest in more deals. When you try something new, they'll trust your integrity and trust your work ethics that you can pull it off, and you are knowledgeable enough to do that. I love it. Dave, I have a few last questions for you. Quick hits, lightning round. So one book or resource that shaped your real estate mindset?
I like Cradle to Cradle by McDonough and Baumgart, which is almost like an engineering book as much as a real estate one, about the right way to create products. And I think that applies to real estate. Another great one is Let My People Go Surfing by Yvon Chouinard, the founder of Patagonia. And it's really, he used the MBA strategy, which is management by absence, getting great people, training them up, and then leaving and letting them figure it out without him. And that was very successful to build an independent company that works with him and for him.
Those are new. I will check it out. Thank you. Most important trait a business leader should develop?
Honesty. I think that's key. It's rare in today's day and age, in the news and everything, but I think it's always going to matter. And there's times when it appears that everything's smoke and mirrors and flashy. But, I think people like Warren Buffett really cultivated and developed this. They owned their losses. Like, good coaches and players, they're going to blame themselves when things go wrong, even if it's not 100% their fault or in their control. So that's the trait I think that's most important for leadership.
Love it. One thing you wish you knew earlier in your real estate journey.
Ooh, I think shop around with banks. I just stuck with one for too long. I probably lost a bunch of money doing that, and I think it's like anything. You want to see compare rates and terms, just like buying a car. Think of it, you're buying a loan. You should shop around.
Yeah, luckily there's a lot of competition in America, and we are open to use any of those people and any companies for our benefit. And I think that's an idea too for our listeners. One of the biggest takeaways: just go out there, talk to people, tell what you got, and usually people will help with advice or with reference, right? That's how you learn people.
Ask for help.
Awesome. Dave, I have one last question for you. If someone want to reach out to you, collaborate, or maybe invest in one of your deals, how people can find you?
They should shoot me an email, directly to my personal email. I'm not hesitant to give that out. It's dave@holmanhomes.com. You can go to my website, holmanhomes.com. We have a contact form there, and I'd love to get to know you and hear what's up.
Awesome. Dave, I love this conversation. It was very powerful. And your approach to real estate and how you grew so quickly, it's amazing. And I love how you structure your vertical growth and you treating companies separately and you're not afraid to try new things. I think this is very interesting and very exciting world. And if we stuck to something for too long, like with your lender, you stuck with your lender and you missed out and you stuck with doing one deal, so you miss out. You're not afraid to move on, and you're not afraid to try new things. And listen, I hope we should have a follow-up recording after you get those buildings up and running, and we'll have a full success story back on our channel.
Beautiful. I'll be the first chalk of 2027. We'll chat a little while for a year from now. Thanks, Alex.
Awesome. Love it. And to everyone listening, if you enjoyed the episode, please like it, subscribe, and leave a review to your favorite platform. We'll include all of the Dave's links and resources in the show notes. And as always, keep moving forward.